Assalamu alaikum. My name is Isha Sayyed and I have two group members named Ali Nawaz and Ahmad Nawaz. Today, the topic of our presentation is the role of central banks in both developed and developing countries. As we all know that central banks plays a crucial role in managing a nation's economy and the specific functions they undertake can differ depending on the country's development stage. My part in presentation is introduction and difference between developed and developing economies. So I'm giving you a little bit introduction about developed and developing economies and explain their characteristics. Number 1, developed economies. Developed economies are those who have high levels of economic well-being. They are characterized by a strong infrastructure, they have advanced technologies, they have intelligent workforce, and the living standard of their citizens must be high. If all these characteristics are found in an economy, so that economy will be known as developed economies. On the other hand, if there is an economy having less developed infrastructure, no good transportation services, they don't even have heavy machineries and efficient labor, and the level of their income is very low, but still they are focused on fulfilling basic needs for their population. So these economies must be known as developing economies, and they may be actively working towards achieving developed status. Now I'm going to explain some basic characteristics of developed economies. Number 1, high income levels. High income levels are measured by GDP or GNI per capita. These economies possess strong financial foundations. Per capita income in developing countries is high because service sector contributes significantly to GDP, encompassing sectors like finance, healthcare, education, and technology. These sectors are generally high value, means they generate more income per worker as compared to primary industries. Developed economies invest heavily in research and development, leading to advancements that increase productivity and efficiency. This translates to higher output and economic growth. While the service sector takes center stage, a strong manufacturing base often remains producing high value goods that can be exported. It also has a skilled and educated workforce. This leads to higher worker productivity, means worker can produce more goods and services per hour. This increased productivity directly translates to higher GDP per capita. Another main characteristic of developed economies are diversified industries. Economies are characterized by a diversified industrial landscape, means they don't rely heavily on just one sector. Developed economies are at the forefront of technological advancements. This sector includes research and development in various fields, from medicine and engineering to artificial intelligence, as well as high technological manufacturing products like electronics, machinery, and other technology driven goods. Production of complex and technologically advanced products like automobiles, aircraft, pharmaceuticals, and specialized machinery. These goods are often exported to other countries, generating revenue and contributing to a positive trade balance. Third main characteristics of developed economies is advanced infrastructure. Well developed infrastructure is crucial. Reliable transportation networks, communication systems, and utilities are commonplace. In transportation, extensive and reliable transportation networks includes well-maintained highways and secondary roads, public transportation like subways, trains, trams, and buses. Efficient air and sea transport infrastructure connects developed economies to other countries and facilitates international trade. In energy, reliable and efficient energy production and distribution, well-maintained electricity grids, and there's often a focus on renewable energy sources like solar, wind. Last one is high standard of living. Citizens generally enjoy a good quality of life, which access to quality healthcare, education, and social services. Developed economies offer a higher standard of living for their citizens due to a combination of factors including strong financial resources, access to quality healthcare and education, robust social safety nets, and well-developed infrastructure. However, it's important to acknowledge that challenges still exist, and ensuring a higher standard of living for all citizens remains an ongoing pursuit. Although there are many other characteristics of developed economies as well, but I've just explained some of the basic ones as I mentioned above, and I hope that it will be clear to you all. Now we are going to talk about some basic characteristics of developing economies, which includes lower income levels, focus on primary industries, limited infrastructure, and lower standard of living. Number one, lower income levels. The lower income per capita in developing economies stems from a combination of factors. Their reliance on lower value industries, limited infrastructure and education, political instability, and rapid population growth all create challenges to economic development. However, many developing economies are experiencing rapid growth and are working towards achieving the characteristics of developed economies. Number two, focus on primary industries. Primary industries are the sectors of economy that extract raw materials directly from the nature, like agriculture, mining, forestry, fishing, etc. Developing economies often focus on primary industries due to a combination of abundant resources, lower investment needs, foreign investment opportunities, and the necessity of meeting basic needs. However, this reliance can have drawbacks, making diversification crucial for long term economic success. Then we have limited infrastructure as a third main characteristic of developing economies. As we all know that many developing economies are experiencing limited infrastructure, which is a major challenge for them. It hinders economic growth, lowers the quality of life, and contributes to poverty. Addressing this challenge requires a multifaceted approach that includes increased government investment, attracting private sector participation, and focusing on sustainable practices. By overcoming these infrastructure hurdles, developing economies can pave the way for a brighter future. Now, fourth and last one is lower standard of living. The lower standard of living in developing economies stem from a combination of factors, all interconnected and creating a cycle that can be difficult to break. As compared to developed economies, developing economies have a smaller GDP. This translates to lower average income per capita, limiting the resources available to citizens for basic necessities like food, shelter, and healthcare. Developing economies may have limited access to quality healthcare. This can be due to a shortage of nurses, doctors, and hospitals as well. Access to quality education is also limited in developing economies, which can restrict job opportunities and perpetuate poverty. Poor infrastructure make it difficult to access jobs, education and healthcare. Political instability and conflict can create an environment of the uncertainty and fear. This can discourage investment, disrupt economic activity, and lead to displacement of people. All of these factors contribute to a lower standard of living. Rapid population growth can strain resources and make it difficult for the standard of living to keep pace. Thanks to all of you. That's all by myself. Now, the rest of the presentation will be presented to you by my other group members, Ali Nawaz and Ahmad Nawaz. Over to you guys.
Assalamu alaikum. My name is Ali Nawaz, and today my topic in presentation is the central bank and its role in developed economies. So first of all, we will look at what is the central bank. A central bank is a financial institute that oversees a country's monetary system and a monetary policy. Here are two core responsibilities of a central bank in both developed and developing economies. The number one is money management. Central bank have exclusive control over production and distribution of a nation's currency. Second one is a monetary policy. Central banks are responsible for formulating and implementing monetary policies. Now moving to next slide. Role of central bank in developed economies. Central bank play crucial role in managing a nation's economy, but their approaches can differ significantly between developed and developing economies. Here is a breakdown of the key difference. The number one is a monetary policy instrument in developed economies. Developed economies with their established financial market primarily rely on indirect instrument for their central bank to implement monetary. These instruments influence the money supply and credit availability, ultimately targeting economic goals like price stability and growth. Here are the key monetary policy instruments used in developed economies. Number one is open market operation. This is the most crucial tool the central bank buys and sells government bonds in open market. Number second is reserves requirement. Central bank mandate the minimum amount of the reserves commercial banks must hold against the deposit. Third one is a discount rate or a repo rate. This interest rate the central bank charges commercial bank for borrowing reserves. Now moving to most important inflation target. Inflation target has become a dominant monetary policy framework in developed economies since the last 20th century. Here are the some benefits of inflation targeting. It it promotes price stability, which encourage investment and economic growth. Business and consumer can make plans with more certainty. It makes monetary policy clear and predictable, fostering public trust and confidence. Third one is a financial inclusion. Central bank in a developed economies also focus on the financial inclusion remains a relevant concern. Now moving to next slide. On this slide, top of its slide, there is a central bank independence. Developed economies often have a central bank with a greater independence from the government. This allows them to focus on long-term economic goals without political interference. So, what are the reasons that the central banks are independent in a developed economies? Here are two main important reasons. The number one is a legal framework. A strong legal status establishes the central bank's mandate, objectives, and operational independence. This limits government interference in decision-making process. The number second is a governance structure. Central bank typically have independent boards of governance. This insulate them from political pressure associated with the short-term election cycles. Second is promoting a healthy banking system. Central banks in developed economies wear many hats when it comes to promote a healthy banking system. Number third is a sophisticated tools. They have a well-developed toolbox of the monetary policy instrument and utilize them effectively to achieve their objectives. Developed economies boost central banks with a robust toolbox of a monetary policy instrument. These tools go beyond the basic levers of interest rate and allow for a more nuanced control over the economy. Here's breakdown of some sophisticated tools used by the central bank in developed economies. Central bank don't just react to economic situation; they can also proactively manage expectations through forward guidance. This involves publicly communication their intention regarding future interest rate adjustment. By clearing stemming their likely course of action, central banks can influence market expectations about inflation and interest rate. This helped stabilize market and guide economic activity in the desired direction. The last is a focus on a long-term stability. Their primary concern is a maintaining sustainable economic growth and a price stability over a long time. While addressing a short-term economic fluctuations can be tempting, central banks in developed economies prioritize long-term stability to foster a predictable, sustainable, and a prosperous economic environment for both business and consumer. Thank you.
Assalamualaikum everyone, this is Ahmad Nawaz and from here on I will be discussing this topic. My topic is about the role of central bank in developing economies. The basic function of central bank remains same in both developed and developing economies. Here I am going to present the role of central bank in developing economies which are different from developed economies central bank. Central bank in developing economies focuses on direct monetary policies. Central bank in developing economies tend to rely more on direct methods of monetary policies compared to their developed counterparts. Direct monetary policies includes credit rationing, direct lending, and moral exhaustion. Developed economies have well-established financial market where indirect instruments like interest rates, adjustments, efficiency effectively influence the broader economy. This may not be the case in developing economies where financial markets are less mature. तो जैसे कि मैंने बताया कि जो डेवलप्ड इकोनॉमीज़ होती हैं वहाँ पे जो है वो फाइनेंशियल मार्केट में जो है वो इनडायरेक्ट इंस्ट्रूमेंट यूज़ करते हैं जैसे कि इंटरेस्ट रेट्स, लेकिन ये जो इंटरेस्ट रेट है ये डेवलपिंग इकोनॉमीज में या डेवलपिंग कंट्रीज़ में उस तरह से इफेक्टिव नहीं होते जैसे कि वहाँ. इवन इफ इंटरेस्ट रेट आर चेंज, द मैसेज माइट नॉट इफेक्टिवली रीच आवर borrowers and lenders in developing economies, as I mentioned earlier. This can limit the effectiveness of indirect tool. Financial inclusion gaps. A significant portion of population is developing economies might be outside the formal financial system, relying on cash or informal lenders. Indirect methods may have less impact on their behavior. Secondly, focus on development. Developing economies prioritize promoting economic growth alongside with price stability. While maintaining price stability is core function of any central bank, there is a growing trend of central bank in developing economies to play a more effective role in fostering development. The broader mandate goes beyond just monetary policy instruments. Here's how central bank in developing economies are focusing on development. Firstly, promoting financial inclusion. Central banks can create policies that encourage banks to reach unbanked population. This might involve relaxing regulations from microfinance institutions or facilitating mobile banking penetration. The other component is enhancing financial market efficiency. Developing economies often have shallow financial markets. Central banks can introduce new financial instruments, promote credit rating agencies, and encourage competition among banks to improve overall efficiency. The last component, but not the least, macroeconomic stability for growth. While not directly promoting development, central banks play a vital role by maintaining price stability and low inflation. This creates a predictable economic environment that encourages investment and long-term planning, both crucial for development. Central bank can work with government to ensure their monetary policies complement fixed fiscal policies aimed at development goals. अब जैसे कि मैंने पहले बात की है फर्स्ट कंपोनेंट में कि जब भी हम रिलैक्स करेंगे अपनी रेगुलेशन माइक्रो फाइनेंस इंस्टीट्यूशन के लिए या फिर हम मोबाइल बैंकिंग बढ़ाएंगे तो उससे भी जो है वो हमारी जैसे हम एक डेवलपिंग कंट्री हैं तो हमारी जो इकोनॉमी है उसमें बूस्ट हमें मिल सकता है. या फिर हम जैसे कि मैंने दूसरे कंपोनेंट में बात की कि अगर हम कॉम्पिटिशन बैंक्स के बीच में बढ़ा देंगे तो उससे भी काफ़ी फ़ायदा होता है इकोनॉमीज़ को ग्रो करने में. एंड लास्टली जैसे मैंने कहा कि हम लॉन्ग टर्म प्लानिंग करें जिससे इन्वेस्टमेंट हमारे मुल्क में बढ़ सकती है या किसी भी डेवलपिंग कंट्री में बढ़ सकती हैं तो उससे भी काफ़ी बूस्ट मिलता है इकोनॉमीज़ को, जो कि हमारे मुल्क में बहुत ही कम देखा गया है. Thing is exchange rate management. Developing economies, especially those with volatile currencies, might focus more on managing exchange rates to attract foreign investment and maintain stability. This is how. Developing economies, especially those with volatile currencies, often have a strong focus on managing exchange rates. This is because a stable exchange rate can offer several advantages for attracting foreign investment and promoting economic stability. Here is a breakdown of why. This is that how to promote foreign investment. Firstly, we have to reduce risk. Foreign investors are generally risk averse. A volatile currency creates uncertainty about the future values of their investment. By managing exchange rates and reducing volatility, developing economies become more attractive destinations for foreign investment. The other thing is predictability. A stable exchange rate allows investors to better predict the return they can accept on their investments. This predictability encourages them to invest in the economy, bringing in much needed capital. And the third component in promoting foreign investment is the competitive exports. A weaker, more stable exchange rate can make countries export cheaper on the global market. This can boost exports and attract foreign investors interested in participating in the growing export sector. Now, the question arises that how to maintain stability in such developing countries or economies. Curbing inflation. Firstly, volatile exchange rates can lead to unpredictable import prices, which can feed into inflation. By managing the exchange rate, developing economies can create more stable environment for businessmen and consumers, forecasting economic growth. And the other factor is confidence and growth. A stable exchange rate promotes confidence among domestic businesses and consumers. Businesses can plan for future with more certainty, and consumers have a more predictable purchasing power. This overall stability can lead to increased economic growth. Other factor is limited independence. Central bank in developing economies might have less independence due to the need to coordinate with the government on border development goals. This can sometimes lead to short-term political pressure influence monetary policy. The other thing is government pressure. Government in developing economies might exert pressure on central bank to lower interest rates to stimulate economic growth in short term, even if it risks inflation. And the other thing in this case is lack of transparency and weak institutions which are like, for as I mentioned, the lack of transparency, limited transparency in central bank decision-making process can raise concern about accountability and create opportunities for political influence. The other thing I mentioned, weak institutions. Developing economies often have weaker political and legal institution making it harder for central bank to resist political pressure. Now, talking about the last factor, which is limited independence, it can harm the monetary policies in a long run. Central bank in developing economies might have less independence due to the need to coordinate with the government on border development goals. This can sometimes lead to short-term political pressure influencing monetary policies. The first thing, government pressure. Government in developing economies might exert pressure on central bank to lower interest rate to stimulate economic growth in their short period of governance, even if it risks inflation. Lack of transparency, limited transparency in central bank decision making processes can raise concern about accountability and create opportunities for political influence. Other thing, weak institutions. Weak institutions, developing economies often have weaker political and legal institutions, making it harder for central banks to resist political pressure. Now, here are the consequences I will be telling you that due to limited independence. Firstly, higher inflation, political pressure to lower interest rate can lead to central bank accommodating inflationary policies. This can have negative consequences for economic stability and long-term growth. Currency volatility. Lack of confidence in central bank commitment to price stability can lead to increased exchange rate volatility, harming foreign investment and economic activity. The last thing, but the most horrible one, is deteriorating of credibility. If central banks are perceived as lacking independence, their ability to influence economic expectations and behavior diminishes, weakening the effectiveness of monetary policies.